Hooty hoo, all my stock market gamblers. Welcome today. It's Wednesday, August 11th. What do we got going on? Well, you know what? You can't make this stuff up. We're at a new record high in the Dow, record high in the S&P. The markets only go higher. Isn't this incredible? Well, I think at some point. Now, right now, we're in the seventh month. Seven straight months. Straight up. No correction, no pullback, nothing. Just straight up. New records. Now, can this go on forever? Forever? No. Can it go on a little while longer? Absolutely. And it feels like it wants to keep going. But then again, just if they pass the $3.5 trillion infrastructure bill, well, that should make the markets go up a couple hundred points. But a market is not healthy that just goes straight up. It's just not. A healthy market has corrections. It has pullbacks. Now, I do see a correction coming. I do see it. I don't see the crash coming yet. Kind of surprising. At some point, the crash is going to come. I see a correction coming. I see a correction of about 10% coming. The market is just not ready to crash. They just want to keep printing money. The money has to go somewhere, so it goes into the stock market. Okay, let me ask you a question. This is a question I think about a lot. Right now, we have, well, the government will tell you we have 5% inflation. Okay, to me that seems like a lot. That's a tax. That's a tax of 5% on your money every year. 5%. It just goes away. Purchasing power goes away. But the real rate of inflation is about 14%. You can go to Shadow Stats, look it up. It's about 14%. Now, to me, 14% sounds incredibly high, right? Now, my question for you is, at what point do you think the government's going to raise interest rates? How high does inflation have to get before the government starts to raise interest rates? Interest rates are pegged right around 0%. Now, inflation at 14%. What if inflation goes to 30%? Do you think the government would raise interest rates off of zero? Do you think they would raise? Well, I'm not sure they will. I don't think they can. You see, the reason I don't think they can is because if they raise the interest rates, the U.S. will default on all of its debt. The U.S. has $28.5 trillion just in debt. That's not unfunded liabilities, which is over another 100 trillion. I just want to know if there's any point where the Federal Reserve will ever raise interest rates again. I say no. I say the Federal Reserve is just going to print money until this thing blows up. And I'll tell you why I think that. Now, I'm a real estate broker. Now, you look at the housing market. The housing market has never, ever been a hotter market. I mean, there is just no inventory. House prices have gone up 25% in the last year. 25% year over year. Now, here's my next question for you. At what point do housing prices have to increase per year? Right now, we're increasing about 25% per year. Okay, how high do house prices have to get? We're at record highs. We set a new record. I think for the U.S., the average price home is now up around $380,000. Okay, at what price do homes have to get to before the Federal Reserve has the guts to stop buying $40 billion a month in mortgages? Why the heck does the Federal Reserve have to buy mortgages when we're in the hottest housing market possible? Why is that? I mean, tell me, if houses go up 50% this next year, if they go up, let's say they're at 400,000 now, let's say the average price home goes to 600,000. Will the Federal Reserve stop buying mortgages? I don't think they will. You see, I think they have this go until it blows up, and it's going to blow up at some point. Now, what I want to talk a little bit about is when the stock market, these bubbles, when they blow up, okay, the housing market, when the stock market bubbles blow up, where does all the money go to? I mean, Literally, trillions. People are going to lose trillions. Trillions, not billions. Trillions of dollars is going to be wiped out. Where does that money go to? Well, does it just go to money heaven? Does it just disappear? Well, here's the thing. Let me explain it in houses because it's easier for me being in the housing market, a broker and all. Anyways, houses, when they're going up, right? We're at $380,000 for the average price home. But let's say that we start to get a shift, which we're getting right now. Actually, we are getting the shift. And let's say that the buyers just throw their hands up. I'm not paying these ridiculous prices. I'm just not going to pay it. Okay, so the buyers, now they're not going to pay it. But let's say people want to sell now, and you get, on one street, you get 10 people want to sell. There's 100 homes, but there's only like 3 buyers. Okay, there's only 3 buyers. Well, the first guy, he makes it out at, his top price. The next guy, maybe a little bit less, and the next guy, a little bit less. But now there's no buyers left, and there's still 7 more people that want to sell. Now, in real estate, sometimes you get people that have to sell. They have to sell for some reason. Maybe someone died and the heirs have to split the house up. They have to get out. But there's no buyers. The 3 buyers, they already went away. They already got took with the other ones. There's 7 more homes for sale. So what happens? Those houses, they drop. They drop really fast. Like they drop that guy may have to, the next guy that sells, he may have to take half. And that's only like 4 people out of 100, right? So it's the marginal people that bring the whole price in your neighborhood down, right? Because that's the new comp. That's what people compare it to. Nobody's going to pay above the price of the last sale when they're coming down. They just won't. They won't pay above. They'll have to go lower and lower and lower. So it can go down really fast. But my point is, let's say you don't want to sell your house. You're just sitting there, and let's say your house is $1 million right now. Okay, it's worth $1 million, and you're all happy, because you only owe $600,000 on it. You got $400,000 of equity, so you're sitting back with the big smile. Oh yeah, I got $400,000 of equity now. I can go to the bank and I can borrow money against my equity. Oh, I'm sitting fat cat. I'm just the fat cat right now. Well, what happens when those prices get cut in half? Now you owe $600,000, but now your house is only worth $500,000. Well, that big smile turns into the sad face. Oh, that sad face. You can't go to the bank anymore to get money. As a matter of fact, bank might call you up and go, hey, that $600,000 loan you got? Well, we changed our mind. We want our money back. Your house isn't worth it. So, you might get pressure from the bank to actually pay them back. Okay, so in the stock market, it's the same way. Now, if everybody wanted, let's say Apple stock, okay? Millions and millions of people own Apple stock. Let's say they all wanted to get out right away. What would happen? Well, could they all make it out at this price? Could they all make it out at the high price? Not a chance. Not a chance. When everybody's running for the exit, there's not enough room for everybody to get out. And when panic hits the market, it changes in a heartbeat. It changes so fast. Now, yeah, the top guys, they make it out. And now where does they put their money? Well, I think their money, they put it into other things. Maybe they go into commodities. Commodities right now, I think, are cheap because, you see, here's what I think. I think that everything is in a bubble right now. I think stocks are in a bubble. I think real estate's in a bubble. And I think the bond market's in a bubble. Now, what are they in a bubble against? They're in a bubble against real money, what I call real money, which is gold. Gold and silver, they're in a bubble. These things are in a bubble. Now, when the bubble pops, now gold and silver become the precious things you want. You want gold and silver. Now, a lot of people say that's not true. They say, Mike, when the market comes down, gold and silver is going to come down with it. Now, what gold and silver do is they hold your purchasing power. Now, right now, look at the Dow. The Dow's at, 35,000, let's call it. Let's call gold, 1750. Okay. So it's 20 to 1 right now. It's 20 to 1, the ratio between one share of the Dow to one ounce of gold. 20 to 1. Now, when everything crashes, and I agree that everything is going to crash, I believe it's going to come down. Okay, when it all ends, the ratio between the Dow and gold is going to be about 1-to-1. Now, maybe gold comes down. Maybe it comes down. Maybe it comes down, right? But the Dow, if gold is coming down, the Dow is going to be crashing so hard. Because right now, the Dow would have to go from 35,000 down to 1,700. Okay, 1,750, 35,000 down to 1,750. I don't think it's going to happen that way. I think gold's actually going to go up. I think gold's going to go up to meet the Dow. Maybe they meet around 10,000, maybe 35,000 down to 10,000. Maybe gold goes from, 1,750. Maybe it goes up to 8 or 10,000. Okay, but I do believe they're going to be 1-to-1 again. Okay, they were 1-to-1 in around 1930. They were 1-to-1 around 1980, and I believe the ratio is going to become 1-to-1 again. So I think when the market does crash, I think a lot of that money is going to flow into gold. Okay, a lot of people don't buy this. This is just my opinion. I'm a stock market gambler. This is what I believe. So I believe that gold is where you want to be. Now, here's a fascinating story. I might be getting a little long-winded today, but you see, I put a gold trade on Friday, and over the weekend, there was a flash crash in the gold market, right? Right? What happened? What happened? Well, it's interesting. Gold, they have whales. Like Bitcoin, they have big whales that trade, and when they trade in Bitcoin, they can swing that market 80% in one direction or the other. But anyways, this whale of a gold trader came on. Okay, now he came on Sunday night, and he dumped $4 billion worth of gold onto the market. Now, when you come on to make that play at night, the U.S. market's not open yet, right? So he's trading with all the Asian markets, okay, and he's seeing where the bids are going to be hit, and he just dumped $4 billion. And we had this kind of flash crash in gold. Now, gold's rebounding today, and I think my trade's going to be okay. I think I'm out till December. I think it's going to bounce right back. I think it's a gift when they do this. I don't know who it is. Maybe it's J.P. Morgan manipulating the market again. I don't know who it is. But you see, I know that they want to crash the market, because if they cared about what price they got, they wouldn't sell $4 billion all at one time. They would sell it a little bit at a time, try to get a good price for it. No, the guy dumped $4 billion right into the market, and it just flash crashed gold. You woke up Monday morning and go, oh my goodness, my trade I put on Friday, I'm so underwater. But no, it's a gift. Anyways, I bought more. It's coming back. Okay. All right. That's just a little side story there. But anyways, I do believe we're going to get a correction in the stock market. I don't think we're ready for the crash yet. The reason is because trillions and trillions and trillions of dollars are being printed, and they're going to continue to print it. They're going to print it forever. The Fed's going to go until it blows. We're going to talk more about this stuff. If you like talking about this stuff, give me that thumbs up. If you really like it, punch that subscribe button. Now, it's Wednesday today. Get out there and have a great Wednesday. I'm Tall Mike. We'll talk again real soon. Bye-bye now.